Welcome back to our educational video series. Hope you guys had a fantastic summer. I know we all sure did. Today we're going to talk about diving into the credit insurance products. These products are like mortgage life insurance, revolving credit insurance on credit cards, and line of credit insurance. You know, and everyone looks at the positive things about them, but there are some drawbacks to these products. And David and Kevin are going to dive a little deeper into that and educate us all on them. As always, if you have any questions, don't hesitate to call. Enjoy the video. Take care.
So Kevin, what is creditor insurance?
Creditor insurance is designed to pay off a specific debt to a lender in the event that you pass away or become disabled. But as Harry mentioned, there are still some drawbacks to this type of insurance, which we'd like to go over with you.
First drawback is the cost of the plan. Oftentimes getting mortgage insurance or creditor insurance through your lender tends to be slightly more expensive than researching the market and finding your own private policy separate from the loan. The other big hidden cost to a lot of these mortgage life insurance plans is that your premium is fixed. Let's say you have a $500,000 mortgage and the bank's charging you $40 a month to insure it. That premium stays the same for the life of the mortgage. However, over time, you pay your mortgage balance down. So after 10 years, you might only owe $400,000 on the mortgage, but you're still paying that same $40 a month premium. With a private policy, you pay that set premium for maybe 20 years or 30 years, depending on the term you choose, and you get that same benefit, that $500,000 throughout.
Next, this type of coverage itself can be very limited. Unlike traditional life or disability insurance, creditor insurance is designed to pay back a specific debt to a specific lender. This means that you can't name the beneficiary who you want in the event that something was to happen to you, so that nobody else in your family is going to get any money from this type of insurance. It is only going to pay off the specific debt you had.
Another potential drawback for creditor insurance is the potential for claim denials. With a traditional life insurance policy, you are underwritten at the time of application. So you answer a whole bunch of health questions, your eligibility is determined, and you are offered the policy. It's very difficult for those policies to go back and deny your claims later on. With a lot of creditor insurance plans, your claim is underwritten at the time of claim rather than application. And so oftentimes they can say, oh no, you didn't tell us about this diagnosis or this health issue that you had. It was a pre-existing condition, so we're not going to pay out the claim. That is a risk with creditor insurance, more so than a private policy you purchase yourself.
Flexibility is another issue with creditor insurance. As I mentioned, you don't get to name a beneficiary to it, so that's one problem. But also, these types of products can be terminated in the event, for example, you change lenders on your mortgage after it comes up for renewal in the first 5 years. So let's say after 5 years, you take a look around and you're able to find a better interest rate with another lender. If you move to that lender, you are essentially canceling the mortgage insurance you had with your first lender and rebuying it with the second lender. But if you had some type of health issue arise in those 5 years, you may not qualify for that type of insurance after you've switched, or you would have been able to if you had renewed with your original lender. So this is something to consider outside of just finding the most attractive interest rate.
Before coming to Perler Financial Group, I began my financial services sector career working for one of Canada's big 5 banks, and I was working in the branch as a retail lender and investment advisor. And one of the products that I absolutely hated at the bank that we were sort of forced to sell was creditor insurance. The worst forms of creditor insurance, in my view, were the credit card protection and the revolving line of credit protection. Those types of products were particularly bad as they shifted the liability of the debt from the bank to the consumer, but also at a very high fee. Those fees that they charged on those products were pretty astronomical. And of course, the bank loved it. There was a huge profit margin baked into them. And so we were always reminded every single month at sales meetings, hey, force these things down people's throats. You got to sell more creditor insurance. You got to sell more creditor insurance. The mortgage life insurance wasn't as bad of a deal. I do see somewhat the appeal for that, but again, like I said, you do get a declining benefit when you buy your life insurance through a bank that's attached to your loan. So oftentimes finding your own policy privately through brokers like ourselves ends up being a much better financial deal for you and your family.
Keep in mind that there are alternatives to standard creditor insurance. There's more traditional life insurance and disability insurance. And often these types of products come with more comprehensive coverage, more flexibility, and over the long run, a much cheaper cost to the insurance product itself.
As always, if you guys have any questions, don't hesitate to reach out to Kevin or I. But on your screen now is a nice recap that explains the differences between mortgage lender insurance versus a private third-party insurance company. We have contracts with all of Canada's leading life insurance companies, and so we can find the best products at the best prices for you and your family. Thanks for watching, and again, if you have any questions or need assistance, feel free to reach out to us.